That word is probably the most talked about in economics. Several countries have been thrown into prolonged periods of instability due to inflation. There is a common aspiration among central bankers to be labeled as inflation hawks. Promises to curb inflation have helped win some politicians into office, only to see them fall from power later on. Hello folks, welcome to this video about inflation. I'm 100% sure that everyone feels inflation's effects, even if you don't realize it. And you also face the impact of inflation and want to know what it is, its definition, impact, causes, etc. So, without further ado, let's get this video started. Prices rising over time are what we call inflation, and it causes a slow but steady erosion of purchasing power. The rate at which purchasing power drops can be reflected in the average price increase of a basket of selected goods and services over some period of time. Inflation is the general rise in prices across the economy, which hurts businesses and consumers. Today's dollar won't buy as much as yesterday's. An easy way to see the effects of inflation is to compare the cost of a widely purchased good or service from one time period to another. A cup of coffee, which cost 25 cents on average in 1970, now costs $1.59. Therefore, you could have purchased roughly 3 cups of coffee for $5, but in 1970, you could have purchased approximately 20 cups. That's inflation, and it's not just about one thing getting more expensive. It applies to price hikes across an entire industry, price increases of consumer goods, and the economy as a whole. The primary way to track these changes is by looking at price indexes, like the Consumer Price Index, also known as CPI. The CPI is a measure that examines the weighted average of prices of a basket of goods and services which are of primary consumer needs. They include transportation, food, and medical care. CPI is calculated by taking price changes for each item in the predetermined basket of goods and averaging them based on their relative weight in the whole basket. The prices in consideration are the retail prices of each item, as available for purchase by the individual citizens. Economists see the yearly inflation rate being within a range of 2 percentage points as an indication of price stability in a thriving economy. Inflation has negative and positive consequences, but when it's not within a reasonable range, the former tends to outweigh the latter. For instance, inflation can increase spending, productivity, and demand when a country's economy is slowing down and needs a push. The opposite is also true. If inflation starts to outpace wage growth, that may indicate an economic downturn. While ordinary people may be the first to suffer the effects of inflation, even commercial enterprises are not immune. When the prices of necessities like food, utilities, and gasoline rise, the purchasing power of households declines. When the prices rise for inputs needed in production, such as raw materials like coal and oil, intermediate items like grain and steel, and completed machinery, companies lose buying power and risk declining margins. Companies often respond to inflation by increasing prices, with the result being borne by consumers. As will be discussed further on, it can be tricky for many businesses to find the sweet spot between increasing prices to cover rising input costs and doing so in a way that does not reduce consumer demand. Next, let's go over the 7 most important points to know about inflation. Number 1. Exactly what factors cause price increases to occur, aka inflation. A country's financial regulator shoulders the important responsibility of keeping inflation in check. It is done by implementing measures through monetary policy, which refers to the actions of a central bank or other committees that determine the size and rate of growth of the money supply. In the US, the Fed's monetary policy goals include moderate to long-term interest rates, price stability, and maximum employment. Most persistent periods of high inflation occur when central banks fail to control the money supply adequately. The buying power of a currency declines, and prices rise if the money supply expands too rapidly about the size of the economy. The quantity theory of money postulates that there is a direct correlation between the amount of money in circulation and the size of the economy. Supply and demand pressures in the economy can also have an inflationary effect. Inflation that is driven by supply shocks, such as those caused by natural disasters, or by rising production costs like those caused by soaring oil prices, is known as cost-push inflation. 2008's food and fuel inflation was a case like this for the global economy, with drastically rising food and fuel prices being passed on through trade from country to country. On the other hand, demand shocks like a stock market rally, or expansionary policies like a central bank lowering interest rates, or a government increasing spending can temporarily enhance overall demand and economic growth. But if the economy can't keep up with the surge in demand, we see demand pull inflation due to the strain on resources. The challenge for policymakers is stimulating the economy when it needs a lift in demand and growth without triggering inflation. Inflation is also heavily affected by people's anticipations of future price increases. It is common for individuals and businesses to factor in the possibility of pay raises and contractual price modifications if they believe that inflation is imminent, such as automatic rent increases. Once the contracts are activated and salaries or prices rise as agreed upon, expectations become self-fulfilling, and this behavior helps set the inflation rate in the subsequent period. Inflation inertia occurs when people consistently base their expectations on the most recent past, which they often do. This type of inflation is called built-in inflation. That is it as for factors causing inflation. Ever wondered what can be the pros and cons of inflation? Number 2. The benefits and risks of inflation. There is a wide range of undesirable effects that high inflation has on economies. A decline in buying power occurs when earnings fail to keep pace with the inflation rate in consumer prices. For those living on a limited budget, even a small increase in price can have devastating effects. Consequently, increased labor expenses due to workers' requests for wage hikes can reduce profitability for corporations. All of these ripple effects of inflation might make investors nervous and discourage them from taking risks. Inflation isn't necessarily bad. An optimum level of inflation is often promoted to encourage spending to a certain extent, instead of saving. If the purchasing power of money falls over time, then there may be a greater incentive to spend now instead of saving and spending later. It may increase spending, which may boost economic activities in a country. A balanced approach is thought to keep the inflation value in an optimum and desirable range. Number 3. Who gains from inflation? Inflation is good for borrowers with fixed interest rates and owners of assets that rise in value with inflation. With inflation, interest payments on these debts will become a smaller percentage of total income. As inflation affects some markets, those who hold assets in certain markets can reap benefits. If energy costs are rising, investors in the energy sector may benefit from rising stock prices. During times of rising prices, value equities tend to outperform growth companies. With the factors, causes, pros, and cons, every individual should know who inflation hits first. Number 4. Inflation affects who exactly? The victims of inflation are usually savers and lenders. The purchasing power of those who have money in savings accounts declines, whereas the value of loans made at low fixed interest rates remains constant until maturity. Inflation harms buyers as well as sellers, since prices rise across the board. People with lower incomes may feel the effects of inflation more acutely because they spend a larger share of their income on necessities than those with higher incomes, and thus have less of a buffer against the erosion of their purchasing power. Moving forward, let's look at the past extreme examples of inflation to get an idea of how it works and what impact the term can make. Number 5. Inflation in its extreme examples. All global currencies are fiat money. Therefore, quick increases in the money supply for political reasons could lead to equally rapid prices. The hyperinflation of the German Weimar Republic in the early 1920s is the best known example. The Allies of World War I wanted reparations from Germany. However, the country's paper currency had become so devalued due to government borrowing that it could not be accepted as payment. German officials considered printing paper money, using the funds to buy foreign currency and then using that to settle the country's debts. This approach resulted in the rapid depreciation of the German mark and accompanying hyperinflation. German consumers, sensing that their money would lose value the longer it sat in savings, rushed to spend it as soon as possible. As more and more currency entered the economy, its value sank to the point where people wallpapered their homes with worthless marks. The scenarios in Peru in 1990 and Zimbabwe in 2007 to 2008 were also very similar. Number 6. Why is current inflation so high? Inflation rates in the United States and elsewhere reached their highest point since the early 1980s in 2022. A confluence of factors has led to a dramatic increase in inflation worldwide. Yet no single factor can be pinpointed as the cause of the recent price spikes. Factory shutdowns and shipping port congestion were just two examples of how the COVID-19 pandemic in early 2020 severely impacted global supply chains. Simultaneously, governments increased unemployment benefits and distributed stimulus payments to help cushion the financial blow to individuals and small enterprises. With the introduction of COVID vaccines and the subsequent rapid improvement of the economy, demand, aided in part by stimulus funds and low interest rates, quickly exceeded supply, which has yet to recover to its pre-COVID levels. In addition, as a result of Russia's aggressive invasion of Ukraine in early 2022, the international community imposed several economic sanctions and trade restrictions on the country, reducing global supplies of oil and gas. Concurrently, food prices increased. In response to the rising cost of fuel and food, businesses throughout the supply chain had to raise their prices. And finally, there is built-in or expected inflation. Many economists, investors, and consumers have, for years now, expected inflation to start rising due to the Fed's monetary policy, which has kept interest rates near zero for over a decade now, and simultaneously has pursued a bond-buying program called quantitative easing. Number 7. How to hedge against inflation. Stocks are considered to be the best hedge against inflation, as the rise in stock prices is inclusive of the effects of inflation. Since additions to the money supply in virtually all modern economies occur as bank credit injections through the financial system, much of the immediate effect on prices happens in financial assets that are priced in their home currency, such as stocks. Special financial instruments exist that one can use to safeguard investments against inflation. They include Treasury Inflation Protected Securities, TIPS, a low-risk treasury security that is indexed to inflation, where the principal amount invested is increased by the percentage of inflation. One can also opt for a TIPS mutual fund or TIPS-based exchange-traded fund, or ETF. To get access to stocks, ETFs, and other funds that can help to avoid the dangers of inflation, you'll likely need a brokerage account. Choosing a stockbroker can be a tedious process due to the variety among them. Gold is also considered to be a hedge against inflation, although this doesn't always appear to be the case looking backward. Briefly summing it up. Whenever there is a general increase in prices and a decline in the currency's purchasing power, we get inflation. In 2022, inflation rates in the United States and elsewhere reached their highest point since the early 1980s. There is no single cause for the quick increase in world prices. Rather, a confluence of factors such as the fallout from an expansionary monetary policy, the COVID-19 pandemic, and the shock to oil and food costs caused by Russia's invasion of Ukraine. All of these have contributed to the current situation. And while that's all for today's video, do let us know what you think about inflation by leaving us a comment. To catch us soon though, click on that bell icon and don't forget to subscribe. Until then, take care, and we'll see you soon.